All eyes are on the Fed, but our guest says on this side of the border, the Bank of Canada, in fact, wants to hold out for the Fed to cut rates first. And he says that there could be further weakness here in the Canadian dollar if a hawkish Jerome Powell, the Fed boss, emerges today. We're joined by Jamie Murray, Portfolio Manager and Head of Research at the Murray Wealth Group. It's great to see you.
Thanks for having me.
That's interesting. You think that the Bank of Canada is reluctant to bring down rates before the US?
I think they're definitely a little reluctant. I think we're seeing that globally, even in Europe. And it's economics 101. A lower interest rate in Canada, especially with a little bit of inflationary pressure still, is going to hurt the Canadian dollar US exchange rate. And that, in turn, puts more pressure on inflation here in Canada. So central banks around the world are really taking their cue from the U.S., but we are seeing the pressure ramping up now, especially given the weak inflation data we saw last week. That might force Canada to move a little bit earlier than it would really want to, especially if the U.S. holds out past June rate cut expectations.
That's interesting, yeah, because we import so much in this country that a lower currency is inflationary.
For sure, as well as on the exporting side too. Calgary would love it if we had a little bit lower exchange rate, you get more for your oil, and that's going to spur activity out there. So you'll get a little bit of inflation on both sides that way.
What stocks are you watching for in the market right now? What area of the market, say, offers the most promise, do you think?
Yeah, so I mean, at the end of the day, we're global investors. We're looking around the world for the best opportunities. We're actually finding some good opportunities out of Europe right now. And one name that's a little topical, given the results we saw out of a company called Kering, which is a company that owns Gucci and Balenciaga and other luxury brands. The shares are down about 15% from the time it reported a Q1 sales warning. And we saw shares of LVMH, Louis Vuitton's parent company, sell off in response to that. Now they've come back a little bit, but this is a name that we think we're coming out of a bit of a slowdown in luxury. There still is pockets of weakness, as Kering showed us. This was mostly the Asian market that was the cause of most of the weakness. But we think these true luxury brands like LVMH, they can create scarcity no matter what the economy is. And we think it's just trading around 20 times PE. We think there's lots of growth ahead. It's done a great job layering acquisitions. If you remember, the last one they bought, large company, was Tiffany's. And so they bought Tiffany, the jeweler. They've integrated that into operations. They're expanding that brand globally. So they have a really good platform for growing these brands around the world.
Maybe we could have a quick look at Lululemon, because the stock is down about 9% so far this year. We're expecting their earnings tomorrow. Now, I know they're not as ludicrously expensive as Gucci, but they are something of an upmarket brand. Definitely,
they're an upmarket brand. It's been a great performer over the last 3-4 years coming out of the pandemic. But we have seen the shares top out a little bit. It's not quite as expensive on the sales price, but the PE ratio is a little bit more expensive actually than these luxury companies. And so you really do want to see that, they call it the power of 3 model, which is growing their men's, growing their store base, growing internationally, as well as their core women's segment. So they've done a great job of it so far, but we do think they are finding a little bit of pushback on the consumer spending side. We are seeing weakness still in consumer discretionary, as well as from new competition like Alo and some other of these athleisure wear players.
We've heard now, Bloomberg is reporting that Sinochem, the big Chinese energy giant, has bought one of the first shipments that'll come through the expanded Trans Mountain pipeline system.
Right.
You have some thoughts what that means for the Alberta energy sector?
Yeah, I mean, I think the more takeaway capacity out of Alberta, the better it is for the whole sector. Now, certain players benefit more than others. We've recently bought shares in Cenovus Energy just last week following its investor day. We think they have a great long-term outlook. I think Cenovus is going to be the largest or one of the largest shippers on the Trans Mountain. So they'll be selling their crude overseas as well. And it trades at a little bit of a discount from these other oil sands peers like MEG, Suncor, and Canadian Natural trades at the biggest multiple of them all. But we see no reason why Cenovus won't benefit from these new export markets as well. They have some issues in their refining segment in the U.S., and we see that turning around in 2024 and 2025 as well. So I think Cenovus is a great way to play the TMX coming on stream.
Michael Dunn of Stifel just did a big takeout on Trans Mountain. One thing that was new to me was that apparently this will tend to narrow light oil discounts in Canada as well, because light oil will also go out on that system.
Yeah, I mean, Canada's constrained on its takeaway capacity across the board. And funny enough, it's great. It's going to be a good 3-4 years, but given all the growth plans these oil companies have, we could be back in the same situation 3 or 4 or 5 years down the road. And so another interesting way to play that market is Gibson Energy, which is a big handler of storage, GEI, on the TSX. It's got a great dividend yield, very secure. They have a big export terminal they just bought in Texas. So as more crude flows through there, they'll have opportunities. And again, they're always looking for new opportunities to store oil as companies bring it into its hubs in Hardisty and Edmonton to prepare for export.
Finally, Airbus shares at an all-time high. Now, I think I'm too old and cynical, Jamie, but the CEO of the company yesterday said, "Oh, we're not happy to see these troubles with Boeing," as if he's not happy.
I mean, his bank account's probably happy because I think it's been helping move the shares up 20% this year. Boeing down 30%, so a huge divergence in the performance of the two companies. I mean, even if you look back to pre-pandemic, Airbus is moving, share price is hitting all-time highs, moving past where it was in 2019. Boeing is still just trading about half of that level. And I mean, yeah, we've owned Airbus for almost 5 years now, and we'll continue to hold it. We think there's more pain ahead for Boeing and more bad news on the way.
I bet when the Airbus executives meet, it takes them about 20 minutes before they stop laughing and actually get down to business. Apparently, the French finance minister said, France, a major shareholder in Airbus, said he would hesitate before he gets on a Boeing plane.
And I mean, you can't blame him. It is even now on Expedia and some of these travel websites, you can actually see what the plane is going to be. And
is that right?
He's not. I'll fly on a Boeing plane.
Yeah.
I'm not worried, but he's not the only person out there who's going to think twice about which plane they get on for the next flight.
And Boeing apparently warning of a massive cash outflow. I think it's for Q1 because of all these woes.
Yeah, and I mean, we still think it's a necessary company. It's in this duopoly with Airbus. The U.S. government needs and wants Boeing around.
Yeah.
We think it will get fixed over time. We think there's been a cultural issue in terms of the engineering, giving way to the financial teams and how it's operated and how it's run. Mm-hmm. So that'll reverse. They will clean it up, but it could take a few years, and there could be more pain along the way, even whether it's an issue with an airplane like we've seen, or even just tighter regulations, or sort of the Department of Transportation tightening the noose on them in some ways.